When I look at the 50 biggest gold miners in the GDX, there's no clear outperformance, right? We have operating leverage, so they move stronger with the gold price, but they move stronger with the gold price in both directions, right? They move stronger up, they move stronger down. There's no clear outperformance of that portfolio.
Always makes me
nervous.
very comfortable.
JD, we spend a lot of time analysing gold miners. We try and work out how valuable a gold miner is. We try to figure out how valuable a resource is and how economically it can be constructed to get that dirt out of a ground process turned into gold bars, all for it to sort of be stored and work as this sort of store of value. We spend all this time figuring this out on the company level, but we rarely actually zoom out and think, what the hell is it all for? What are the dynamics in the gold market? Why does all this exist? What are the correlations? What does it mean for society? And we're going to go very philosophical today with Dr. Dirk Baur.
We are, mate. I'm incredibly excited. Some of the research that Dirk has done, the energy he has put towards trying to understand why this gold, this wacky and weird commodity that drives so much of what we talk about, like you say, and a good chunk of the economy here, why it behaves the way it does, why it trades the way it does, why we praise it the way we do. And yeah, it's a super fascinating point of discussion, I find, as well as some of the other stuff that he has unpacked from other related metals, PGMs. You've got silver, how they kind of trade, how we should think they might behave in a financial crisis, in just a period of volatility. There's so much interesting information that you can glean from Dirk here, from somebody who's studied this for 20 odd years. And that's just scratching the surface of what he's looked at.
Dirk's not your usual kind of interview for us. Dirk's an academic, but he studies a lot of the historic relationships when you look at the financial gold market that exists today, and we think that gives us some insight about the future.
100%. And there's all these like misconceptions and preconceived notions that I have about how gold shares might behave. So I was very excited to unpack this with him.
Dirk Baur, is gold overvalued or undervalued right now?
Correctly valued, I think.
Correctly valued.
Market values, right?
The context, of course, is you co-authored a paper, the relative valuation of gold in 2019. And what do you uncover when you compare gold's valuation to other asset classes?
Yeah, good question. You can always compare gold with stocks and silver and other commodities and oil and this. We know this the gold copper ratio and stuff. And so I think that paper was mostly focusing on ratios, right? So they give us some indication that that one asset is maybe higher value than the other, or the other way around, right? The copper gold ratio is, does that tell us that if it's high, that gold is overvalued or that copper is undervalued? And so it was more an investigation to see how valuable or how informative these ratios are. But I'm in general critical of these ratios.
Why is that?
Yeah, because the gold copper ratio. So is gold overvalued or copper undervalued? So I don't know. There could be so the ratio gives me like a starting point to look like a little bit deeper into the valuation of gold, the valuation of copper, but the ratio per se, I think is can be a problem. Or I would just take it and say okay, just because it's high, that means that gold is overvalued, for example.
How on earth do you come up with a valuation framework for gold in the first place? Or
we don't have any, right?
Yeah.
So even like Ben Bernanke, the Fed chair, said no one understands gold, and then he said that he doesn't understand it either. Strong claim that no one understands it, but what he meant is that no one really knows how to value it, right? And that's because the traditional method to value stocks, for example, or assets is you have cash flows, right? And then you discount them, and then you come up with a valuation, and then you cannot really do that with gold, right? That will be the same for. It's a problem for many commodities, right?
And you've also spent a long time thinking about its sort of role as a safe haven and also a hedge. I'm curious to have you start by just separating the differences there between a hedge and a safe haven.
Yeah. So a hedge is something that works on average, like or at all times, essentially. And the safe haven is different because it's only supposed to work or has a special function in crisis periods or in periods when we have financial turmoil or something extreme happens. Could even be a black swan event like COVID, right? That's then when the safe haven property kicks in. The hedge is something that should work on average at all times, right? But not particularly in crisis periods or extreme periods.
And how does gold then, piece into that? Do you see it as a hedge, a safe haven, or both?
Yeah, it's both. But I mean, one of the big things is, or the main property I think is the safe haven property is really valuable to investors because when everything crashes or falls, like most assets fall, gold doesn't. Right? That's the safe haven. Like people go into the safe haven, like that safe harbor, and because they then move from risky assets to gold or other gold, like I mean, government bonds is the other safe haven asset. When they do that, then of course that um, pushes sometimes gold even up.
Yeah.
That's the safe haven property.
Yeah. Now, it gets even more interesting, though, because most of us, if we are interested in gold, we don't hold necessarily just gold in our portfolio. We will hold gold stocks, and they don't behave the same, do they?
No, they don't.
So how does the relationship fall apart, and how quickly do you sort of see that fall apart in these crisis times?
So it falls apart because gold is not really related to the market, not even on average. So the correlation of gold bullion with the market is essentially zero. In the short run, in the long run, they move together, but not in the short run. Gold shares they do not have that zero correlation, so they are correlated. They are like equities, so they are correlated with the market, and because they are correlated with gold, but also with the market, when the market drops, gold shares also drop. Right? And they do not decouple from the market. They actually almost recouple, or that relationship strengthens. So the market pulls the gold shares down. And that's essentially explaining why the big difference between gold and gold shares. And it's also sometimes confused. I mean, I even remember like a Wall Street Journal article when Warren Buffett bought Barrick, right? And they said, he's doing that because gold shares are a safe haven. And it's I don't think he did it because of that, but it's also not true anyway. Gold shares are not a safe haven.
What are the other sort of misconceptions, the big misconceptions? You've studied gold more than most over the past 15 years that you've kind of shattered along the way, or even, misconceptions you might have had prior that have really changed once you dug into the weeds?
Yeah, I mean, I often heard that there's no gold has no intrinsic value, or I think it was also highlighted when people talked about Bitcoin, and I said Bitcoin doesn't have any intrinsic value, and it's all based on beliefs. And a little bit of that is also true for gold. I mean, the big difference, of course, is that gold has been around for millennia or forever, right? And there's a lot of also psychological stuff embedded in like
the
all our
Lindy
thinking.
effect.
Sorry?
Have you heard of the Lindy effect?
No.
The longer something has been around, the more likely it will continue to be around.
Yeah. And so that's maybe then the big difference to the other one, right? But it's because it's so hard to value. So that was one of the first things that I think noticed or read about, and I think it's true that it's hard to value, and it's all based on beliefs, right? I mean, if tomorrow people said like, look, we don't believe in gold anymore, which would be, it's a strong assumption. I'm not telling you that or saying that they will do that. Also because central banks hold so much, for example, and it's almost the opposite, that the beliefs are stronger today. There's some indication that beliefs in gold are stronger today than maybe 10 years ago, not only because the price is higher, but also because of central bank action and that we've seen recently. But going back to your question, so I don't remember any kind of misconception around. It's just like the safe haven. The safe haven in general is often people don't really get it. They think that there's also that people say like when an asset falls after an event, after a safe haven event or after a crisis or a shock, and they say like this asset now has lost its safe haven property, and that's a big misconception because like the safe haven property means that like an asset like gold goes up in a crisis, but then after the crisis, it's natural, it's part of the safe haven property that it goes down. So then to say like, look, it has now lost its safe haven property, that's a misconception. That's wrong.
Ultimately, people buy gold because because of geopolitical fears, because they're worried about inflation and eroding their purchasing power over time, and all of that. Yeah, I guess like ties into the compellingness of owning gold. But like when you zoom out, you think we spend so much money mining, getting this out of the ground, and it kind of all gets locked up in a vault. What's the economic good of all of that? It's kind of a meta question when you think about it. But the fabric of trust in society exists because of an understanding that this thing ultimately is the hardest money that there is. And whenever we really put the quality or the durability of our money to test via inflation or printing too much of it or quantitative easing, that's the thing that kind of holds up over time.
Yeah, you're right.
Is that the conclusion you've come to?
Yeah, I agree. And it's that recent central bank buying, gold buying, that the fact that they increased their reserves significantly since 2022 is evidence of that, right? That I mean, you could argue that, well, like now that everything becomes more virtual or like AI and more digital, right? Like who would buy gold? But even central banks buy it, right? I mean, there's another reason that they perhaps want to diversify their US dollar holdings and maybe get away from that dominance of the US dollar. But anyway, then again, right? So gold then competes with the US dollar in today's world. Right? Because you mentioned inflation, that's maybe a misconception. I mean, when I look at the data, there's no strong. I mean, gold has so clearly outperformed inflation that you could call it an inflation hedge, maybe. I mean, people call it that, but I think when you think of an inflation hedge, you would more intuitively may think more like inflation goes up by 3%, gold goes up by 3%, right? But when we look at it historically, it's more like inflation went up by 3%, gold went up by 10%. So it's not. I mean, yes, it preserved your purchasing power, but it did so much more. So I think it's a little bit misleading to call it an inflation hedge because
it tracks more M2 money supply than it does CPI, right?
Much more. Yeah, you're right. Yeah, also had recently looked at that. Much more, but then there's still much more than like there's still this excess thing above M2, but it's much closer to M2. Yeah, you're right.
Yeah.
There's some further sort of nuances as well with how gold equities and gold performs in these crisis times and in safe haven times, because foreign exchange comes into the mix. What have you sort of learnt in amongst that, with people perhaps flocking into the US dollar when things get nasty or other such trends?
Yeah. So gold is also called a currency hedge, and I think that's like I don't see any misconception there when I look at the data compared to the inflation hedge. And what that means is that and it's particularly relevant for Australia and for the Australian dollar, because when usually in a crisis, global financial crisis, COVID, the US dollar tends to appreciate, which is then not as good for US investors and their gold holdings, because there's I mean, even if when gold goes up, but then because if the US dollar goes up, then that would kind of push gold a little bit down in US dollars. But it's easy to explain maybe in the Australian dollar context, because in a crisis, usually the Australian dollar falls because money leaves Australia. And then gold in Australian dollar goes up a lot, right? So in an Australian context, gold is a currency hedge like in all other currencies, but in the Australian context, it's much more important because the Australian dollar is so much more volatile than other currencies. And because the Australian dollar is not a safe haven currency as the US dollar.
And we saw this quite well in the Liberation Day chaos in early April, where Aussie gold just held up remarkably well.
Yeah.
Is it curious at the moment? Like you talked about those times of crisis where the equities they're hyper correlated with the rest of the equity market. I look at this year, and even though there hasn't been an event of like extreme volatility absent kind of Liberation Day, the gold equities have been like super resilient. Other parts of the commodities market or market in general have been like really volatile. Does that kind of match up to your historic like work on understanding, the correlation of these, or do you just think there hasn't been a volatility event to test it in the same way that there was like in COVID-19?
Yeah. So when we look at for example, the last 20 years, the gold shares and gold relationship, so the first 10 years between 2005 and 2015, they looked really bad for gold shares. I mean, they're like, I don't know. I mean, there are many reasons why gold shares clearly underperformed gold bullion. Recently, in the last 10 years, they didn't really clearly. Well, there's no clear underperformance. And for those that
Unless you look at
underperformed,
Barrick.
yeah, exactly. There's always exceptions, right? You're right. And then there has been, because we look at long data, right? But more recently, as we know, 2022, the Russian invasion into Ukraine has like changed a lot in terms for gold. Also, this decoupling of the interest rate gold relationship, right? That is also something that we have only seen recently. And then this resilience could be another one that I mean, things may change, right? And there's the gold market is quite in a. We have to. I don't want to rush to conclusions, but clearly there has been like different things like we've seen than in the last 20 years. Just in the last 2-3 years, things have changed.
What does silver do from here? It's in a quite an interesting point in time, and you've often clumped it in together with gold.
Yeah. There was an article in the AFR about silver a couple of months ago, and then there was an interview on it where they asked me like, is silver the new gold, right? And then I had another look at silver and the gold relationship, and there I couldn't see any big changes to the historical patterns. So silver is still so much more volatile than gold. Silver doesn't really perform as a safe haven, hasn't outperformed gold in any way. So it's last time I checked, that was just 2 or 3 months ago, that there was nothing like what I just said about gold, that there seems to be things are a little bit different, right? Or potentially different, but silver seems to be very similar.
Would you call yourself a gold bull?
No,
Why?
because as an academic, I'm interested in gold. I'm more and more fascinated by gold, because that's the usual thing. Like the more you do research, the more things get interesting, right? You dig deeper and then you find more stuff. But that isn't I think it has, in terms of bull. I mean, bull is like, what is it? Like, do I predict the price to be 4,000? Like whatever, right? So I don't like to make predictions, but I see the value in gold. And I mean, what I said about central banks, for example, is a very strong indication that I wouldn't be, or that there are like big institutions that believe in gold. I've also done a study on institutional investors, big funds in the US, and their gold holdings, and like 1/4 of them hold gold. And potentially then they have even increased, or I mean, 1/4 held like around 2%. Wouldn't be surprised if they have like increased it a bit, right?
And they're doing that because, like you said, the historic correlation is zero with equities, and they believe that you get diversification benefits. The benefits of diversification you've explored. It's not a free lunch though. Why?
So you read all my papers. That's amazing. It's not a free lunch. That's a very recent paper. I mean, this goes back to Warren Buffett essentially, right? I mean, Warren Buffett always says that you have to diversify if you don't understand the businesses. So he always talks about businesses, right? And clearly, if you have a full understanding of your assets you're investing in, and it could be just 1, 2, 3, then why hold a portfolio of 30 assets, right? Because that comes at a cost. If you think about it, you could, if you just you look at the like everything that is investable, and then you look at the one that you're sure that this will give you the highest return over the next couple of years. If you're sure about it, well, you just want to invest in that one and not diversify away all that upside, right? Yeah. And that's essentially why I said it's not a free lunch. I mean, there's that's a misconception returns, that you get when you diversify, you get something for free. And I like this. I was interested in that because there's this famous saying, like, there's no such thing as a free lunch. So then it seems like there's a contradiction here, right? I mean, the diversification and they also say that diversification is the only free lunch. So in that paper, I'm saying it's not the only free lunch. There is no such thing as a free lunch.
So risk goes down, but returns quite likely
returns go down, right?
Go down as well.
Yeah,
you could have always made more with a concentrated bet in the best performing thing when you look back. Yeah.
Something I'm really curious about in the world of what you've kind of studied, Dirk, is as you mentioned, gold has been around for millennia, but a lot of these studies say when you focus in on the safe haven nature and you compare how gold has performed to equity markets across the world, a lot of these studies and the ones you reference were done over a 30, a 40, a 50-year period. But if we take into context a lot of the recent chatter about maybe we're at the, coming to the end of the US dollar being the reserve currency, do you think there's potential shortcomings in the study, given this could be perhaps a 1 in a 200-year type event?
Well, longer, I think we would look at longer periods if that would make sense, but because the gold price was fixed to the US dollar up until 1971, it doesn't make too much sense to go back, right? I mean, for example, I could probably see some safe haven effects also before 71, maybe shadow, like black market gold prices or something, but the official gold price was fixed, so then there's no movement, right? And then it doesn't make sense to go back further, right?
And pre the dollar peg,
Yeah,
the data is just too hard to come by.
Well, there is data, but then it's all pegged. So what can I do then,
What are you
right?
measuring? Yeah. So that was the end of Bretton Woods, 1971, right?
Yeah.
How has that changed the monetary environment and the perception, the value, and everything relating to gold since when you do look at the data?
Well, I mean, when we look at the data, we see that the price was, I think, around 40, and then suddenly it fluctuates, right?
Yeah.
And then pretty soon after that, there's this like big jump in, or like, I mean, that was the late 70s, when coincides also with this the cornering of the silver market, and then gold goes up a lot, right? And then so that's what we see, and that's not surprising. I mean, you fix something and then you let it free, and then it moves a lot, right?
Yeah. You let the Mr. Market do its thing.
Yeah.
Is there anything we could glean from going back hundreds of years, though, before the US dollar was even the reserve currency? I know this sort of data must be extremely hard to come by and pretty patchy, but is there things we can learn about how investors behaved back then?
Investors, not so sure, but I mean, this inflation hedge, or the fact that it preserves your purchasing power.
Yeah.
I mean, that there are studies that went back 2,000 years. You may have seen that 2,000 years ago, apparently you could buy a nice suit for like 1 ounce of gold, and you could still do that. I mean, then of course there's always a problem, like what kind of suit can you buy with 1 ounce of gold today?
Yeah.
Blah blah blah. But so that in that context, there's studies, but I've never seen any financial study on how gold then was used in a financial context. But as clearly as money, we have some study, right?
When people get excited about any commodity, it's usually when it's going up and the animal spirits kick in. Is there any, like, when you look at the data, is there any benefit to be had of trying to time your buying and selling strategies as it relates to gold, or is it kind of ultimately pretty difficult to just beat the buy and hold?
Yeah, it's, I mean, difficult to beat it. I've also done a study where, in terms of that safe haven, like we looked at it, could you just not hold gold, and then whenever there's a crisis, then you buy gold? And when you do that, you usually lose. So it's better to buy and hold, right? Because the problem is that no one really can. There may be people that think they can, but I don't think that anyone can predict a crisis. And then once we see the crisis, then it's too late to buy. I mean, you can still buy gold, but if you do, then you do worse than someone who holds it at all times.
What do you think of gold miners in general as a way to play a gold thematic?
To play,
like to have exposure to a gold bull market.
Yeah. So I'm currently working on a paper, and it seems that in a rising gold market, gold shares do pretty well.
Yeah.
It's the problem is more when
it's a window
when the
of
price
time.
it's that window, right? Yeah. And when the price falls, then they clearly underperform, right?
And you've dug quite a bit into explorers, developers, producers. Can you break out the findings there more?
Yeah. So we looked at, for example, the effects of COVID, and when COVID hit, gold was did its thing, gold bullion. Right? So it remained pretty stable. So it was a safe haven for investors. But the gold shares then decoupled from gold.
They got
right?
smashed.
They got smashed. And when we look at it, then the producers they got smashed. They also got smashed, but they performed best among the three producers, developers, and explorers. Developers were the second worst, and then explorers, not surprisingly, they got smashed the most. Right?
And they're the ones with relatively little capital, so it gets more into that company side of things as opposed to safe haven. They might find it hard to access capital and these sorts of things. Yeah.
Can you tell me a little bit about when you look at well, I guess first we've got to set the scene. Tell me a little bit about the negative return asymmetry volatility in commodities.
Mm-hmm. So what we see traditionally, or in for stocks, we see that negative shocks have a increased volatility by more than positive shocks.
Yeah,
that's there's a word for it, like the leverage effect. They say like when stocks fall, then your debt equity ratio deteriorates, and then the stock becomes more risky. So then when it falls, the whole stock becomes much more risky, and then volatility increases by much more.
There's more volatility to the downside than the upside.
Yeah.
What's that? It feels like an exaggeration of the saying you take the stairs up and the elevator down,
Yeah, a little bit like that, yeah. And but then I found that for gold, it's inverted. So for gold, negative shocks do not increase volatility by more, but positive shocks increase volatility by more. And that just highlights, we could say, like, look, gold bullion doesn't have any debt. So then, of course, why should there be such a leverage effect, or the same effect as we see in stocks? But then also in a safe haven event, that's usually the event when the negative shocks are the biggest for stocks, gold does the opposite, right? So then the positive shocks for gold are on the other side of the coin of the negative shocks for stocks, and then that explains why then positive shocks increase volatility by more for gold.
It's reallocation of capital
than the negative shocks.
But there was something that happened, like when you can see a difference when the gold market became financialized in the mid 2000s. Like how does the market behave differently post being financialized?
Yeah, so that leverage effect, or this kind of inverted asymmetry that you were asking about, that kind of weakened a lot, and it almost disappeared. It seems like now it disappeared. So there's no effect for gold, right? But it's still different to stocks. The stocks still have that negative shocks increase volatility by more than positive shocks. Gold is now more like negative shocks, positive shocks, like the same, right? But it could be financialization, or just that we are in a very long upward market now, right? Or like bull, you could call it bull market. And then of course in a strong bull market we haven't had a big crisis. I mean, the COVID crisis was relatively short, right? Much shorter than the global financial crisis. So that could be reasons why it looks as if it has weakened. We have to see if there is a next safe haven event, so then will it then strengthen again that effect?
I think this is a really interesting point. Can you just explain in simple terms what you mean by the financialization of gold over the past decades?
Yeah. So there's a whole literature on the financialization of commodities. And that just means that investors play a bigger role in trading, for example, also oil, in the oil futures markets. I mean, there was studies that say or agricultural commodities, that they used to be, that investors didn't play a big role 30, 40 years ago. And then in the 2000s, then investors kind of realized that, there's some diversification benefits we can to also invest in commodities will help us improve our returns, lower the risk. And that has led to this financialization. In terms of gold, could be the same thing, right? I mean, the more people, it seems that there has also been, the safe haven has been highlighted more often, the diversification benefits of gold, the currency hedge benefits. Then of course, investors look, I should have maybe 2, 3, 4% of gold in my portfolio. And that's also kind of a financialization that now gold is in many more portfolios. And so that's financialization. And then there's also risk associated with that, of course, right? Because the more people held it, then it could also at some stage be part of that, the usual a bunch of assets that then you may even sell if you have to. Right?
Yeah.
And all of this, I guess, assumes as well that the financialization is what you can get exposure, I guess, in a different kind of format. You don't actually have to buy physical gold, store it yourself.
Just think of speculators descending on the market and finding something else to bet on.
You can bet on futures, all that sort of stuff becomes more liquid. And the gold bulls would certainly argue that not all of this paper gold is backed, and that's also a big risk. So
Mm.
is there any evidence to some of the those theories that there's a lot of claims to gold out there as a result of the financialization that probably don't manifest in reality?
Yeah, possibly. I mean, I've seen that. I think I read about that like 15 years ago, and then they said, "Oh, there's a big risk," and that so far we haven't seen like it hasn't real like there's no problem so far, right? Um, there could be the European Central Bank has recently written like a small piece in their financial stability report where there could be some problem for some banks when they have these when they cannot deliver the gold. Maybe. I mean, it's like to me it seemed that the risk is not too big for the financial system. Maybe it's big for one bank, but I don't think it has a like systemic or systematic relevance or impact.
We can start talking about whether Fort Knox even has the gold as well next.
Mate, don't get me started on the refiners.
Dirk, I'm curious on the theme of financialization. I didn't come across a paper on this specifically, but I'm curious if you've thought about the role of ETFs and ETFs that hold gold equities as well, and what kind of impact they've had given their dramatic rise in the past decade kind of plus.
Yeah. So the gold ETF, I mean that's by like the GLD, right? For example.
Yep.
I mean, if you think about it, or we're still thinking about it, and we hypothesized and think that if an investor has an option or the choice, can say, I invest in the ETF, in the gold ETF, or I invest in a mining company, or I invest in a portfolio of mining companies through the GDX, for example. What should I do? And if you think that gold mining companies, that some of them will do very well and will outperform the gold price, others will not do so well. So maybe on average, then they kind of closely track the gold price. If that's the case, why not invest in the gold ETF, the bullion ETF, right? And that's maybe a puzzle that the gold mining ETFs are. I mean, why do you invest in those? I'm not sure. I mean, clearly you can get access to a whole portfolio of gold mining companies, but if you believe in the upside of gold mining, like some gold mining companies will do really well relative to gold, I mean, then you should maybe pick, right? And I'm generally not telling anyone that they should pick stocks, but in this case, it's a special case because you have an alternative, right? If I want to get exposure to the S&P 500, I can buy all these stocks, which is super expensive, or just buy the ETF, right? But then there's in the equity space, there's nothing like that. There's no other product which is like an underlying S&P 500 bullion kind of thing, right? So then it makes sense to buy the S&P 500 ETF. In the gold context, it's different, and that's very interesting, I think, right?
Yeah. Well, people would argue they want operating leverage and they haven't done the stock specific research. So they buy the ETF of diversified basket of miners.
Perhaps even financial leverage as well.
Yeah. Is your argument that you could maybe use financial leverage on the bullion product to approximate the desired amount of net leverage that someone's looking for?
Yeah, but I mean, you're right. You could do that.
Yeah.
You're right. But I mean, when I look at the performance of the gold miners, like on average, or like a bunch of them, like 50 biggest gold miners, like in the GDX, or it's like 77 or 60, or like whatever that is, right? There's no clear outperformance, right? I mean, they have when we look at we have operating leverage, so they move stronger with the gold price, but they move stronger with the gold price in both directions, right? They move stronger up, they move stronger down. And then there's also this market exposure, right? But relative to gold, there's no clear outperformance of that portfolio. And because there's none, what's the difference to why not invest then in the bullion ETF, right? But just to be clear, I'm not saying that there's clearly some great picks
Within that
like
index, yeah.
within that index,
Yeah.
whereas like maybe I should invest in that, or like I just pick 3 or 4 or 5 because I believe in the upside, and I strongly believe in their outperformance of the gold price. But then again, going back to your question with the free lunch, when you have 50, like will all 50 outperform the gold price? Probably not, right? And so
Maybe
you're then
maybe for a
diversifying away
discrete
that
window.
upside, right? Yeah.
Yeah.
This ties in with another feature which has been super prominent in the last year, and that's hedging. And a lot of companies now try and promote themselves and say we are an unhedged producer. I'm not sure how deep you've sort of dug into the world of hedged versus unhedged performance, but do you have numbers you can wrap around and sort of thinking in a rallying environment? Do the unhedged producers actually perform better, or is it mixed results?
I mean, this goes back to, I think, a fundamental question in finance, or what do you want as an investor? And that's also why they now advertise themselves as unhedged, because like you don't want, like you have a lot of products you can choose from, right? You can buy the gold bullion, the ETF, you can do all kinds of things yourself. So then it's not surprising that like the investor wants an unhedged exposure to the upside, right? You don't want to. Well, I don't see why you would invest in a gold miner and say, look, we have hedged everything and we're now very similar to gold bullion. And then it's like, okay, then I buy gold bullion, right? So I want something that is special. And that's why I'm not surprised that they now more say like, look, we're unhedged.
On the topic of hedging, Sean Russo, he would argue that there was this period where a lot of the gold majors had these big hedge books that were increasingly out of the money as gold price was rising. They raised a bunch of equity all at the same time to close out the hedge books, and that discrete window of time where all these gold majors were doing that explained a huge amount of gold's outperformance in that period. Like, they're closing out the hedge book. They're buying the physical gold to close out that hedge book, which pushes the gold bullion price even higher.
Yeah.
Can you see that in the data when you try and explain some of gold price movement?
I could see it. I haven't looked at it, but clearly we could test that observation, or I mean, maybe he looked at it anyway. But
an idea for your next paper.
Yeah, exactly.
Do you find it interesting over the last year? We have seen no great ETF inflows, and I think for a large, quarter by quarter breakthrough, a lot have seen outflows of these ETFs, despite the gold price running really strongly.
So central banks explain that. I think.
Yeah.
Right? So I mean, it's a little bit surprising, you're right, that despite this kind of strong performance of gold, that the ETF flows don't get a flat or even outflows.
It's fascinating.
But I'm not. It's fascinating, you're right, and it's
why?
Why, right? Yeah.
Do you think Bitcoin, an area you've studied quite deeply as well, has sort of eaten gold's lunch a bit here?
Could be the case, yeah. I mean, it's clearly that gold is like Bitcoin is kind of potentially catching up a little bit, and then that could be an explanation. You're right, yeah.
Do you foresee a world? And I know you don't do predictions, but just given the depth in which you've studied the Bitcoin market, where that becomes kind of comparable in size and nature, or are there sort of fundamental characteristics that mean that won't happen?
Yeah, I'm not. Yeah, you said that I don't make predictions. It's true, but I can make, and I like to make conditional predictions. So it depends a little bit how people value tangible assets or the tangibility of gold. So if in 10 years people say, look, I mean, everything is virtual, digital, like AI, like I'm happy if I can just, touch some stuff, but I don't have to touch any my assets like gold. Fine, right? I mean, then maybe Bitcoin will catch up and become equal or even overtake gold. Will take, I guess, much more time than 10 years, like if that happens. But I'm not sure, because currently, even with the apparently younger generations that like even younger generations or younger people buy gold. So it seems that, okay, they are on social media, they do everything digital, but then they still value something that is tangible. And now going forward, if that doesn't change, then Bitcoin may catch up, but take very long time to overtake or even level with gold.
Yeah, you could see Walmart selling out of all the little coins they're
Yeah.
selling, and
Yeah.
all sorts. Thinking forward, perhaps in decades again, can you imagine a world in which we have a gold standard again, given how much you've sort of studied the history of gold?
Not really. When we look at how, like, the current, environment where it's really hard to get consensus across countries, like trade war and all these things, right? I don't really see them coming together. It's like, look, let's do a gold standard again, right? Because it failed also because of coordination issues. So I don't see that happening. Yeah. It's more that I see that the US dollar, that the dominance of the US dollar, I think it's more like that that dominance will kind of weaken, that other currencies will become stronger.
Yeah.
And that's something that I see, and that gold could then also play a role in that mix, and that's supported by that gold buying of central banks.
A recent
recent one,
proposed bill to be passed to lift the debt cap by another 5 trillion I saw recently in the US. I mean, that's got to be a pretty damning outlook on.
It's a small number these days.
Yeah, it's almost an admission that there's no desire to get out of that debt trap in a sensible way.
Yeah.
At this point in time,
and that's, I think, supporting gold, right? If you think about it, I mean, there's all this money, and then, like, what does that mean? 5 trillion, right? Or and then gold is tangible. That can explain a lot of that, I think. Yeah.
You've written papers on green gold. This was a concept that was creating much more headlines a few years ago than it might be today, but it's still a really interesting concept. And of course, in the market, you had Bellevue being the champions of this by trying to run a lot of, getting all their power needs from solar and wind and these sorts. But you came up with your co-authors with a few novel ways of thinking about this, leaving the gold in the ground and such. Can you sort of run us through your thinking on this?
Yeah. So the starting point was, again, I think, or at least the starting point of the paper, but also I think our starting point was Warren Buffett's statement that it's pretty stupid when what we do, that we dig gold out of the ground and then, like, do a lot of stuff, and it's rather expensive. Then we put it down in the ground again, like in vaults, essentially. And people, like he said, that people would be scratching their heads if they observed that. It's like, well, like, is that stupid or inefficient or whatever? So then the idea was to say, look, there's a lot of people out there that invest in gold, but they never look at gold. I mean, that not like a lot of Indians that wear their gold and that have jewelry, and so they just invest in gold. They never look at it. They never want to touch it. They don't have it at home, right? And for those investors, it could be like an option to say, look, I mean, we don't dig it out. We leave it in the ground. It's pretty safe. We have a clearly uncertainty about the amount of gold that is in the ground, but that is kind of priced in. And then we showed that because the in-ground gold is, like, the market value is, like, between, like, 1 and 10%, right? Maybe let's say 5. So does it matter that it trades if it trades at a discount? Would that matter if an investor wants exposure to gold? No, right? So we show with exploration companies, it was like, this is the closest proxy to in-ground gold, where they don't really have they're not producing, right? They just have kind of access to it. That then a portfolio of exploration companies could, like, tracks the gold price closely, almost 1-to-1, like, if you pick it, like, if you do it right. And then that was one idea. So, like, look, I mean, if you want exposure to gold, you could also have in-ground gold exposure, or if there was an in-ground gold, like a securitized in-ground gold vehicle, that could give you a 1-to-1 exposure, and it would trade at a discount to the official world market gold price, but it doesn't matter because you want exposure to it, right? You could just then buy more. Right? That was the idea.
Do you think it gets any traction?
Well, whenever we presented it, for example, also the like, front of MBAs at UWI, mining, from many from the mining industry, they don't like it very much. some of them reacted really like aggressively towards that concept, which is I think that's encouraging, right? When someone reacts in a really aggressive way, like okay, like why? What's your problem, right? And clearly, when you're in the mining business, you don't like to hear that. Well, we leave it in the ground, right? But I highlighted then over the years that this could just be. It's not about you stop mining. It's more like you keep doing what you're doing anyway. But there may be areas where it's really hard to mine anyway, and maybe then you could trial that in-ground gold securitization, right? That you don't dig it out, and you just offer more to investors, right? And I mean now that ESG, there's a lot of push, like particularly from the US, like against ESG and all that environmental stuff in the US, right? But when we abstract from that, I mean, if you value the nature and if you say like it makes sense to care about the environment, then it could be an option. It's like, look, I mean, you have you can buy the traditional gold, and that's clearly disruptive to the environment a little bit at least, or you buy that in-ground gold. So you have a choice, and to have choices is a good thing, right? And the market could value that, and like will that trade then at a premium or not, right? When I hear that investors care about the environment, I think it's a beautiful concept, but I don't see too much evidence for it, right? Because if they did, then there would be a lot of stocks that no one would invest in, right? But then here I think there's an opportunity there, right? We have written a follow-up paper. It doesn't happen pretty much nowhere on the planet because governments don't allow it, right? In the Australian context, you can get a mining lease, but you cannot get a lease to leave something in the ground, right? So that's a barrier. But in that follow-up piece, we also tried to highlight why governments may not like it, because clearly then you have less jobs.
Royalty revenue.
Yeah. But the royalty, like if you securitize that in-ground gold, then you could also have to pay royalties. I mean, there could be something where the government said like, okay, we still get some money, right? But then again, it's not a 0-1 thing, because like we still do mining, but we just do more. So one could even argue, look, government, you could even get more if you allowed that too.
Right. I know your like exploration of Bitcoin as a potential digital gold transcended into exploring like stable coins as well, and stable coins as the potential new money market mutual funds. What's your view on after looking into this question?
Stablecoins. I mean, you mentioned that recently that Tether now goes into gold, right? And the amazing business model of something like Tether, right? Not sure that. I mean, gold and stablecoins is hard to compare that. I mean, I looked into stablecoins just because I also have this like I have an interest in cryptocurrency in general, right? And the Bitcoin. Because Bitcoin was introduced as a payment system or like a payment vehicle, right? And people said, look up at this, like how can, like you will never use that as money because it's too volatile, right? But then of course, stable coins you could use as money, and you could then even use it to transfer money across borders and all that. In the gold context, I don't see a similar vehicle or evolution that we have something like a stable coin, Bitcoin, but that's maybe not your question anyway.
No, yeah, I'm more curious about like the fact that Tether's balance sheet has $5 billion of gold on it, and they're now buying, like majority stakes in substantial stake in a royalty business. It's a pretty new but very substantial like market force, which is kind of apparently attracted to hard money as they define it, primarily being gold, but also Bitcoin.
I think it's a great question because it highlights Tether is almost doing something like what central banks do, right? Because Tether issues like money somehow, right?
Yeah.
And now they also go into gold, so then they do something similar as central banks, because also the major central banks all hold gold as backing, right? Now they also go into that, and it could be just something that they want to diversify their, like again from U.S. government bonds or from government bonds in general, like just diversify those backing. backings, but it's also, if you think about it, if you think like that Tether is kind of a issuing money, and then they do something as similar as central banks.
Like a euro dollar, really. Like,
Yeah.
Yeah. What do you think our audience should, like, maybe any assumptions they should challenge or any takeaways they should have about the gold market or about gold in general that might not be, front of their mind?
Or gold shares as well.
Yeah. I mean, in general, I'm just always surprised that when I read about predictions, like big investment banks, I say like the gold price will do, they like the gold price goes up and then they raise their predictions, right? The gold price falls and they lower their like it's all like just.
It's not exclusive to gold either as well. Every commodity.
Yeah, it's always, but it's all kinds of predictions. Same with the housing market, and like to me, it's always like, why do you listen to these predictions? Because they're never true anyway, right? So, as a warning, well, I don't know what warning. It's just that I don't make predictions for a good reason, right? Not because I don't want to be wrong, but just because most predictions are wrong, right? So, I think if you do your own analysis, and then again, Warren Buffett, like most successful investor maybe ever, if you dig deep and like analyze a company or any asset, spend a lot of time, then you can make good decisions and much better decisions than just like look, I read that report and said like the gold price will do this by 2026, the housing market will do that. Mostly wrong. Right.
Dirk, I've got one final question. You wrote a paper a long time ago on whether football clubs would do well from doing an initial public offering. If in future I can get my hands on a football club and buy a Premier League team, should I take it public or not?
What we found, I think, was that they do. There's no clear better performance on the pitch. I think, right? There were other issues that they maybe had then ended up with less debt because of that going public. But on the pitch, it wasn't clearly like a better performance, right? So then that answers your question, I guess. Right?
Yeah. Well, we want to win trophies, so we'll stick best performance on the pitch.
Yeah. Okay. Yeah, good. When it's just like Qantas comes to mind here. That I like public markets. They're so important, right? And they have so many benefits, right? But there's always these cases where, of course, the stock market or share prices can also lead to underinvestment and to issues, right? And that could then also apply to football clubs.
Qantas is an interesting one because you've got like a nationalised like monopoly that becomes a publicly investable entity versus a football club where maybe it going public is actually just a liquidity event for the private investors,
right.
And the return profiles could be pretty different on those two.
But you buy it to win the Champions League. Have good returns. That's all that matters.
Yeah.
Which team?
It's got to be Liverpool, although it might be out of my price range by then. Perfect, Dirk. I've learned a lot about how gold performs and how gold stocks perform in times of crisis. This has been really interesting. So thank you for joining us.
Thank you.
Good.
Mate, that was awesome, and it is all put together by our fantastic partners. A massive thank you to Mineral Mining Services, Grounded, Sandvik Ground Support, and Cross Boundary Energy. Hoodaroo.
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot, and you need to read out a disclaimer.